folks, welcome to my new channel about value. My name is David and I'm dead serious about my investments. Too often I found information online on YouTube creating more noise than facts, more emotions than economic fundamentals. I want to use this channel as a means to distribute simple but powerful investment ideas, tying story with numbers, combining data with narratives. My goal is not to be accurate, as the market by its nature is unpredictable. But as the Valuation Guru Professor Damodaran from NYU said, you don't need to be right in this market to make money, you just need to be less wrong. Today, I start the journey by looking at Walmart, who proved again to be one of the most stable stocks to own in economic downturns. While the market is experiencing its worst quarter ever in history, Walmart is teasing around all-time highs. My DCF valuation for the stock is $146, and the stock is trading around $120 at the time of production. It still offers a very attractive 20% upside with sound downside protection. To get to the $146 valuation, I have three key hypotheses that we're going to review. First, Walmart will grow its revenue by at least 4% in the next 5 years, thanks to strong performance in e-commerce sales. Second, Walmart will turn its current losses in e-commerce to gains as it reaches scale. As a result, its operating margin reverts back to the mean of 5%. Third, Walmart's management stays smart with their investment and continue to deliver similar results in recent years. So if you want to hear me break down the business strategy, understand their standing in e-commerce and why Walmart is worth a $20 upside, stay tuned and don't go away. Walmart needs a big growth story in e-commerce to justify the $146 valuation. Since 2016, they have gone on a spending spree across the surface of the earth, buying e-commerce companies left and right. Some of the more predominant acquisitions included the US-based e-commerce startup Jet.com in 2016 for $3.3 billion and Indian leading e-commerce platform Flipkart in 2018 for $16 billion. But for Walmart, their success in e-commerce depends heavily on one thing. They must dominate the online grocery market. As the saying goes, you don't know where you're going until you know where you came from. If you look back in history, ever since Sam Walton opened up the first store in 1945, Walmart's business has always anchored on dominating the grocery market first. It is the foundation on which Walmart is built. Walmart lures customers into the store with incredibly cheap grocery to fulfill their everyday needs. As the customers grew loyal and accustomed to the brand, they will also choose to buy the higher margin products such as televisions at Walmart instead of at Best Buy next door. Consumer stable sales leads to discretionary sales, translating everyday needs to luxurious desires. That is Walmart's business model. It stays true to this very day. Grocery and healthcare products represent roughly 66% of the $524 billion of sales Walmart delivered in 2019. Now, as more people choose to buy stuff online, the battlefield changed, but the game plan stays the same. Walmart must dominate the online grocery market to compete with Amazon on a comprehensive scale and deliver compelling top-line growth. I think Walmart is very well positioned to win in this market. Walmart has the three most important things when it comes to online grocery: a strong brand, cheaper price, and accessibility. When it comes to grocery brand, Walmart is second to none. The company absolutely dominates the grocery market in the US, controlling 26% of the market. It holds more market share than the next 7 players combined. The Walmart brand will certainly carry weight as consumers shift to shop for grocery online. Walmart's brand carries weight not only with consumers but also with vendors and suppliers when negotiating for price. Just for references, Walmart accounts for 15% of sales at Procter & Gamble and 13% at PepsiCo. These are some of the world's largest consumer brands, and the smaller guys don't even stand a chance. Walmart's scale will give them significant advantages to offer products at cheaper price point online. This will certainly drive more traffic. Thirdly, Walmart is much more accessible than even Amazon for digital orders. Not only do they offer in-home grocery delivery services, they also offer same-day pickup at no cost in more than 6,000 locations. And 90% of the US population live within 10 miles of a Walmart store. The company simply offers omnichannel capabilities that others cannot match. This is a unique advantage. In 2019, Walmart delivered solid performances in e-commerce. Combining the Walmart US operation and Sam's Club, e-commerce sales grew from $18.4 billion in 2018 to $20.1 billion in 2019, delivering year-over-year growth of 36.4%. In the international market, e-commerce grew 76% from $6.7 billion to $11.8 billion. Both the US and international e-commerce growth numbers beat Wall Street expectations. Walmart's e-commerce operations also outperformed key competitors and the broader index. In 2019, Walmart's 36.4% growth in the US is significantly higher than US e-commerce growth as a whole at 14.9% and Amazon at 20.8%. In international market, Walmart also beat international growth overall at 20.7% and Amazon at 13.4%. These are very impressive numbers for a mature retailer like Walmart. But much like the earlier expansion days of Amazon, this growth did come with a price. According to analysts at Morgan Stanley, Walmart lost around $1.7 billion in their e-commerce operations in 2019. But the good news is that losses is shrinking as sales grew to scale, according to the company's management at Walmart's Investor Day in February in New York City. This is encouraging news. The better news came in 2020 as we are starting to witness a massive shift in consumer behavior and Walmart is taking full advantage. Our friends at the Gordon Haskett Research shared a survey on March 13th that said a third of Americans bought grocery online the week prior. 41% of them used the service for the first time, and among the first-time adopters, an eye-popping 58% chose Walmart, with Amazon coming in second place at 14% and Target at third place at 10%. The Apple App Store rankings told a consistent story. The Walmart grocery app jumped from 20th on the list all the way to first in the past month. Let's do some math. There are 130 million American households. One third of that is 43 million. Among those 43 million families who bought groceries online, 41% are first-time buyers and 58% chose Walmart. So you're looking at 10 million fresh new users at Walmart. This is absolutely amazing. Let's go a bit further. According to the USDA, the moderate cost of grocery per month for a family of 4 is between $894 to $1,068. Let's just take the lower end and say it's $900 per month. And let's say that a very conservative 30% of these new users decided to continue to use the service after COVID-19. You are looking at a $32.4 billion increase in the top line per year for Walmart. And if you're buying grocery online for Walmart, chances are you could also be buying a TV, an iPad, clothes, furniture, etc. This number could be much bigger. I don't know what to tell you. This is a massive story. Walmart sort of proved their e-commerce strategy is working and they're taking full advantage of this once-in-a-lifetime shift in e-commerce adoption. You might have a question. Isn't online sales cannibalizing in-store sales? Well, that's a good question. According to Walmart, users of online products are much more engaged with the brand. They spend twice as much and more in stores. While I don't expect the new adopters to reach the similar level of spending as the early adopters, there is no doubt that this is going to bring significant upside to the top line. So let's come back to the first hypothesis. In my 10-year revenue projection, I'm giving Walmart 4% top line growth for the next 5 years on the 2019 baseline of $524 billion worth of sales before slowly scale back to 2% terminal growth rate. Walmart has built an infrastructure that should support digital percentage growth well into the double digits for the years to come. And these recent data absolutely made me more bullish about Walmart's ability to compete with Amazon on a more comprehensive scale. Going back to my second assumption, I believe Walmart's operating margin will revert back to a historical mean of 5% from the current 3.9% level in 5 years. We mentioned that their e-commerce loss in 2019 is estimated at $1.7 billion, which pressured the margin downwards in recent years. Take a look at the data since Walmart started this journey in e-commerce. Walmart's operating margin in 2019 is 3.9%, and this is the first time time, it dropped below 4% in 6 years. But as the small e-commerce revenue becomes big revenues and losses become gains, I believe their operating margin will revert back to the means, which I believe is 5% in the 2015 level. The sacrifices in operating margins today are to protect the long-term interest of shareholders. So I view these moves as necessary. Another reason to be optimistic that Walmart will turn their margins around is robotics. In recent years, Walmart has been rolling out innovation after innovation to make their stores more efficient. Some examples include the scan and go technology, which allows users to scan the code and pay directly on their phone, saving the effort of a long checkout line. They've also created a shelf scanning robot that automatically scans the shelf to check for inventory. They also collect data to tell store managers which products are hot. As these robotic applications roll out to more and more stores, I believe Walmart will be able to effectively cut costs. So now, look at my 10-year projection of operating profit and margins from a baseline number of $20.6 billion in 2019. In 2020, although we're likely going to see growth in revenue due to high demand in groceries, Walmart will feel some extra pressure in operating margins because of lower demand in discretionary products, which carry higher margins. After COVID-19, combining the innovations in robotics and the turnaround in e-commerce losses, I believe operating margins will revert back to the 5% level in 5 years and stabilize. This is pretty consistent with our growth story in the last chapter. Now, in order to fund the growth, the company will need to reinvest money back to the business. Rather than breaking everything down to capex, depreciation, and change in working capital, I will use sales to capital ratio. The ratio measures how efficient every dollar of reinvestment is in terms of generating revenue growth. In 2019, Walmart's sales to capital ratio is 3.84. In other words, every dollar Walmart reinvests back to its business is able to generate $3.84 of additional revenue. Comparing that to the retail industry overall in the US and globally, we can see that Walmart is reinvesting very efficiently as a global retailer, but fell slightly short to its American peers. I'm going to assume that Walmart will maintain this level of investment efficiencies in the long term as well. So let's look at the 10-year projection of cash flows, which is equal to after-tax operating income minus reinvestments. The free cash flows are ultimately what we need for our DCF models. And now let's look at the model. If you're interested in the full details of my model, feel free to check out my blog. I will provide the link in the description below. But for now, let's take a look at Walmart at the end of the 10-year period and make sure nothing is crazy. After 10 years, Walmart is generating $732 billion worth of revenue, which is a 40% overall growth from the current year. The company's growth will converge to the long-term expected GDP growth of 2%. Under the sales to capital ratio of 3.84, Walmart reinvested $58 billion back to its business to fund its growth over the course of 10 years. Thanks to innovations in robotics and the elimination of e-commerce losses, Walmart turned its operating margins around, going from 3.9% in the base year to 5% long term. A very healthy number for a retail company with heavy focus in groceries. With cost of capital around 6% and adjusted for cash, debt, and cross-holdings, Walmart's equity is worth around $415 billion and $146 per share. Folks, thank you very much for making it all the way to the end. I'm very interested in your story and your point of view. Please leave a comment below and hit the like and subscribe button. Again, this is About Value. I'm your host, David. Till next time. Peace.